Welcome to Berman's Call. We're here to take your questions on both stocks and ETFs today. Here's how to reach us toll-free, 1-855-326-6266. You can email as well, Berman's Call at bnnbloomberg.ca. Larry with us as always to take your questions today. Larry, we have our Prime Minister meeting the American president. Is there hope here that there will be some sort of quick agreement, initial agreement on trade that will reduce some of the uncertainty?
I would say not a chance.
Oh, wow.
I'd love to be a fly on the wall in a room like that. I think Mark Carney has, business acumen in terms of his positions formerly at the Bank of Canada and the Bank of England during two great financial crises. I think he understands, fiscal conservatism. I think he understands the importance of doing a good trade deal here for Canada. But I think the issue is more on what does the U.S. president want out of this ultimately. And it's actually not clear to me, because the direction he's saying, well, we don't need any more oil from Canada. So are you kidding me? Of course you do, right? Like the president says things that I just shake my head and go, oh, like that. And so I don't think we're going to get a deal in the short run. You might get an agreement to have a deal. Yes, which would be even positive, right? Better than the way it is now. Listen, everybody wants a deal. Yes. Like the president isn't wrong about it. No, everyone wants to clean this mess up that he started. But historically, it's taken 18 months to get a solid trade deal done. Sure. And so, in the next, 45 days before, the 90-day window expires, I think extremely unlikely. Are they going to talk in that window? Of course they are. Yeah. So I'm not overly optimistic that we get a trade deal and, everything's off the table. When you look at Kuzma and the way it is now, which was done under Trump's last presidency, what irked him then that he did not get? I'm thinking maybe dairy and lumber, right? That he could still be pursuing now, or do you think that doesn't even matter? I don't think that matters. I think he's taken this tact largely for the implications against China. To say that this is an emergency because fentanyl's crossing the Canadian-U.S. border is asinine to me. Yes. Right? So I think a lot of the reasoning behind it, there are some court cases in front of the courts now that what he's doing is actually not legal. In terms of his powers. So that could be an issue too. Well, we also know Donald Trump doesn't really care about the courts, right? I mean, he is as willing as anybody to say, that's great, but I'm going to do what I'm going to do. And if I need to rewrite this law or put it into an executive order instead of doing a runaround Congress, I will do it. Well, that's true if he can legally do it through executive order. And that's where he's brought on this national security issue around fentanyl and other issues. And movies, apparently. Today was the latest movie industry under the national security this is banner. Hollywood North, right? Yeah. Anyways, I don't see anything anytime soon. Got it. Okay. We will get our questions lined up then for you. That is coming up next. So you can phone us and you can email us. Here is the contact information. The questions today on ETFs and large cap stocks. We're back in a moment. Welcome back to Berman's Call. Thanks for joining us. Larry Berman here to answer your questions today. First to an email from Max. The REIT sector, he says, has been down, but now reviving and offers good value over a long time or a long period. Would Larry recommend CGR, ZRE, or VRE? All have good and high yield holdings. Yeah, so CGR is a global REIT play. ZRE is the BMO one, and that's an equal weight REIT play, and Vanguard VRE is a market cap way to play it. So which is the right way? The answer is there isn't a right way. One's not better than the other. If we look back in history, we can see in Canada, the equal weight approach has been better than the market cap weight approach, but that's not necessarily because equal weight is better than market cap weight. It just happens to be over the past that some of the smaller REITs have done better than some of the larger REITs, right?
Okay.
So it's not a style thing to me. And then the same question can be applied globally relative to domestic. But the REITs coming off the domestic ones compared to an international exposure has better tax treatment. So are you going to be investing in a Canadian taxable account or not? So often when viewers ask questions like that, the answer sometimes is a bit more complex. I think there's a lot of great global REIT payers in terms of yield. But again, there's foreign withholding tax you got to consider as well. So is it taxable or is it not taxable for you?
Okay.
And I would say any one of them at any point in time are great vehicles, and it's going to depend on the individual's need for exposure and how they're being taxed as to which one might be the best at any point in time.
Got it. Okay, some good things to consider. Let's go to the phone lines. Andreas is on the line from Calgary today. Hi, Andreas.
Hello, how are you today?
I'm good.
Hello to you, Larry, as well. Thank you for taking my call. I wanted to know about the company Glencore. Are they good through the thick and the thin? Would they be a good investment here? Or what are your thoughts about Glencore? I'm just going to hang up and listen to what you have to say. Thank you so much.
Thanks for your question.
Yeah, when we talk about base metal investing in general, to me it's very, very cyclical. It's very rarely a long-term growth story where you buy and hold and say, you always want to be there. So that's in particular to precious metals and base metals, where they'll go through periods of months to even years where they're doing great, and then they'll go through periods for months to years where they're just out of favor. When the global economy is slowing, these things cheapen up quite a bit. Glencore is a great company, great operator, and right now it happens to be particularly good value. So I like the base metals here. I've been buying Vale recently for my portfolio, but Glencore fits the bill too, if that's something. Now, is the economy going to turn down and we get a recession? And if we are, these things will cheapen up even more. But I think a lot of these names are already showing that they're on the low end of the range, but there could be a little more downside. So I would be in accumulation mode at this point.
Okay, so keep that in mind that there might be some more slipping. All right, let's go back to the phone lines then. George is on the line from Welland, Ontario. Hi, George.
Hi, happy Cinco de Mayo.
That's true.
My question for Larry is spot price of gold and S&P 500. Are they going to cross paths again and diverge in the near future? And if so, when?
I mean, the price of gold going above the value of the S&P 500. So we're looking at the S&P 500 right now at about 56 to 5,700. I think the question said, are they going, so is gold going to go through that level? The gold bulls are always been painting this gold's going to $5,000 story. So gold falls into the category of what I've been saying recently and with the base metals. There's going to be periods where the performance is great, like now, and then you're going to go through periods of possibly years where the performance is terrible. So right now the trend is higher and momentum's up. From a short-term perspective, I'm a bit better seller here, but I was telling that story when it got to 3,200. So I've been wrong for the last 400 or 500 points on gold or so. So I don't think you'll see that cross anytime soon in terms of valuation. But I'm in the mindset where I want to buy dips in the precious metals because of the dynamics in the world today. I don't want to chase strength. I want to buy into corrections.
Got it. Okay, let's go back to the phone lines. Wes on the line from Red Deer in Alberta. Hi, Wes.
Hi. Long-time follower, Larry. First-time caller. Anyway, interested in an ETF, either a double beta or a regular, both long and short, on the VIX. I need an adrenaline rush once in a while. Thank you.
That is quite an adrenaline rush if you're going that way. Okay, so where would you go with this?
So at our firm, we will actually trade the underlying futures contract as opposed to using the ETF. Okay. So there's a number of ETFs to go net long, net short, and then leverage on those plays. And I don't have a recommendation for them because I don't use them. Okay. Having said that, when you're using the leverage ones, there's a lot of potential adrenaline, and how they rebalance. they should only be used for very, very short-term views, measured in, say, days to weeks at the most.
Okay.
You never want to be holding one of these leveraged ETFs almost for anything, for any extended period of time, say beyond a few months.
Why is that?
Because of the way they rebalance to give you that 2-to-1 exposure every day, they're buying high and selling low. And you don't have to be a rocket scientist to understand buying high and selling low every day.
Yep.
If it's trending, can compound for you, but over time, markets don't go in one direction for too long. They tend to oscillate. So your ultimate return is about how it goes from end to end. And one only needs to look at all leverage ETFs over a 5 or 10 year period to see that natural erosion in net asset value. So I would be very concerned about using them for anything but short-term trading. And I would say any of them are pretty good at it. There's no one that I would say that's better than the others.
Got it. Okay, let's go back to the phone lines. Alex on the line today from Vancouver. Hi, Alex.
Oh, hi, Larry. Thanks for taking my call. Calling about Fairfax Holdings. It's up about 9% since I bought it a couple months ago. And looking at the chart, it's been super steady over the last few years through all the turbulence. So wondering if that's a buy. And also wondering why before 2022 it was relatively flat for a long time. So just wondering about that as well. Thanks.
Fairfax announcing it has a letter of intent to buy the keg.
To buy the keg.
Yeah.
One of my favorite restaurants.
Restaurant, yeah.
It's one right across from my office. I attend quite often, probably too much. So I don't think it's about the keg or anything else. Obviously, good operational management at Fairfax. Long term. I'd have to actually go back and look at why 2020 and 2021 was, I would say, so flat for the stock.
Was that the pandemic?
Obviously part of that, but markets bounced and then recovered. But as the caller points out, the stocks more than doubled in the last year and a half. And I'd have to do some digging in terms of trying to understand exactly what's gone on there. Value as opposed to growth has obviously been in favor for the last 6 months or so that might be an element of it. If you look at our U.S. equivalent of Berkshire Hathaway, for example, big conglomerate with multiple types of investment and good value type management, and you could see a Berkshire Hathaway has also done very, very well in the last couple of years, but it hasn't doubled like Fairfax has. So unfortunately, I don't have a great answer for you. I'd have to do a little bit more work. And if I find something out, I'll be sure to post it on X or somewhere on social media.
Got it. Okay. Let's get to an email then from Craig. He says, I can manage and tolerate risk pretty well, but I bought back into BCE for a great dividend and strength of telecoms. It was 7% of my total. It's now down almost 50%. Should I start dollar cost averaging now, believing for a rebuild? I'm 62 and planning to retire in 24 months or less than 24 months.
Yeah, so 7% in one stock to me is way too overweight.
Okay.
Now, having said that, I know nothing about the person who wrote the email, and maybe concentrated portfolios works for them. Clearly, dividend seeking from that perspective, but I would expect that we were going to see a haircut here. This is obviously parent of this company, so we do have to disclose that. I'm of the view that management hasn't been making the best decisions about over the last year or two. I would much prefer, if you are a dividend seeker, to use the ZWU ETF that gives you not only exposure to BCE's dividend, but many other great dividend payers, the other telcos, utilities, pipelines in Canada, as a better way, if you're a dividend seeker, to have a high percentage of your portfolio in it. You get a lot more diversification, so that when a BCE has had a bad experience, like it has over the last couple of years, you're still generating that income and not seeing a 50% haircut.
So I'll ask a follow-up question, which I think he would ask, which is, it's gone down so much. Should he just ride this out, or should he sell at a loss and move on?
Again, ZWU, I think, is a better way to play it. I've been in BCE since the mid-40s, and I'm not happy at the moment. I have not exited the position.
Okay. All right, good to know. We'll go back to an email now from Hubert. He says, hi, Larry, is ZUQ a great long-term hold for the next 5 to 10 years? Would you add to your position at the current share price? We'll pull that up in a second.
Yeah, so quality is a factor investing. So BMO has a whole series of factor-based investments. Factor, high quality, typically you're going to get a lot of big cap tech in this. So I love the exposure. I love quality as one of my favorite factors in terms of investment factors. Obviously, at the recent lows would have been a much better buy-in. Would I be chasing the quality factor right here, right now with new money? No, I think there's a chance that we revisit the lows that we saw in April if it plays out that we get a harder economic landing. And that could take several quarters to figure out. So if you're sitting in cash and looking for a place for it, I wouldn't buy it today. If we get back to those lows that we saw in April, cash comes off the sideline, put it in. I think you'll be very happy 3 or 4 or 5 years from now. But would I chase the strength of the market right now? No.
Got it. Okay, let's get to another email before break. Email from Colette. What's your opinion of Shopify's outlook going forward? Haven't looked at Shopify in a little while. So Shopify, of course, the e-commerce platform giant. Let's take a look at what it's doing right now. It's at 136.32.
Yeah, I'm wondering if we can get a 5-year picture, Sona, because sometimes, where it is relative to a multi-year time frame when you're looking at charts technically, it matters a lot. So let's see if we can get that up here.
There's a 5-year.
Yeah, and so this area here concerns me from a valuation peak, and so it's not too surprising that when we got into that window earlier in the year, there was too much resistance there. So I'm into buying dips. I wouldn't chase it right here.
Got it. All right, coming up, today's educational segment with Larry. We're back in a moment.
Opinions expressed by Larry Berman are his own and do not necessarily reflect the opinions of BNN, its parent company, or affiliates.
Back to Berman's Call here with Larry Berman. It's time for his educational segment. Larry, go ahead.
Warren Buffett's retiring, 94 years old. That would mean I'd have 34 more years left in my investment career if I stayed around that long. And I'm in my 39th year right now.
Wow.
So, I've learned a few things over the years. And so I jotted down a couple of my ideas. And then what we're going to look at is, well, what does Warren do? Because a lot of how I think about markets did come from Warren Buffett's, my value approach to things. One, market timing is very hard. Warren Buffett always makes fun of technical analysis and charts and all that. So he's not wrong on that part. But he does do market timing. He just does it through other metrics, more sophisticated ways of looking at it, predominantly rebalancing portfolios. And I've got a kind of chart to look at. Diversification is critical. Concentrated portfolios are much higher risk. And I think you need a much longer term focus. So looking at this chart, what we have here is Berkshire Hathaway's cash and cash equivalents off their balance sheet. And that's the blue line here on the graphic in terms of dollars. Okay. And what we have on the other side is the Russell 3000. Basically, it's the broadest measurement of the US stock market. And you can see these red areas are recessions. So going back to the early 90s, what we end up noticing is that Warren Buffett, when the markets buy when there's blood in the streets, so when there's blood in the streets during recessions, he's looking to put cash to work. What was interesting about this period in here, from 1998 to 2002, because when the market was going up, this red line here, he was actually drawing down his cash. He was putting money to work. But he was buying value stocks. He wasn't buying what was beating the S&P 500 at the time. Generally speaking, when markets go bad, he's putting money to work and we see cash go up. What also happened during this period was a huge increase in cash, but that was after the dot-com bubble burst and interest rates went to zero. he started using a lot more leverage, borrowing money in Berkshire Hathaway to invest those dollars. So those are some of the dynamics of Warren's toolbox. Okay, so next chart here is the period of Berkshire Hathaway between 1998 and 2002. And so what you end up seeing here is that Berkshire Hathaway, as the market was going up during that period, and then the bubble burst and the market went down, that's the orange line, Berkshire Hathaway kind of did the opposite, meaning it went down and then it went up as the market went down. So this was him putting money to work in the cheapening value stocks, the Coca-Cola and the Gillette and all those value names that he tends to own. It was only in the last decade or so that he started buying into Apple and other growthier type stocks. So that part's very, very interesting. If you look at long-term performance numbers of Berkshire Hathaway, so I think we can bring this table up here. No, don't have that table. No problem. What have we learned from Buffett's current portfolios? So his current leverage is very, very low. So debt to equity was as high as 40% when markets were cheaper years ago. Its debt to equity is now down to 20%. Okay. So while his cash hoard is very, very high, he's taken his leverage down. He's used some of that cash to pay down some debt. And he's not going out and borrowing a lot. Why? Because it costs a lot more to borrow now than it did when money was cheap a number of years ago. So those are some of his rebalancing tools. So while he tells you don't time markets, and I don't try to, and I try to be fully invested, he's rebalancing and looking for things to invest in. And right now it appears with his big cash hoard and low leverage, he's being very cautious and he's looking for a period of where there's some blood in the streets. We probably put money to work in April. We don't know that yet because he'll disclose that next quarter. And he's actually, where he's put money to work in Q1 was internationally. He bought a lot of Japanese stocks with a very high valued US dollar exposure. Okay. So they were cheap. So he is putting money to work, he is investing, but basically he has not outperformed the market in about 20 years if the S&P 500 is your benchmark. If your benchmark is a balanced fund, like I think Warren Buffett is, he's done great.
Got it. All right, things to learn from Warren Buffett as he exits as CEO by the end of the year. All right, thanks for that, Larry. We will talk again next week, and thank you for joining us. Some options for you if you want to be in touch, etfcm.com, and join us again next Monday.